Hey guys, Austin in the Money here. I know you guys have heard about the wheel strategy, but I'm going to teach you guys how to strangle a stock properly and how to make the most out of it. So step one, you're going to want to pick a good stock. This honestly is the most important stock, or this is the most important step, okay? You want to pick a stock that's good, like Nvidia, great company, reasonably valued. This doesn't mean go do this right here. Oh yeah, man, what a great stock. I mean, yeah, Neo might have good potential in the future, but you're not going to want to pick a stock that, has fallen 90%. You want to pick a good company, a profitable company that has, this strategy can be bad if you pick a stock that has a lot of potential downside. So you want to pick a profitable company. You're going to want to pick a reasonable valued company, okay? Something that's reasonably valued. So for me, I'm picking NVIDIA. Great company. I got in at 106 when the PE was like in the 40s since it has 30 to 40% growth, that's a PEG ratio of 1, which is amazing. So I think NVIDIA still has tons of room to grow, even though it's already around 3 trillion valuation. I think it gets still tons of room to grow. So for the strangle, you're going to want to go to your stock, right? So you're going to want to first sell a put, all right? I like to go like 3 to 4 weeks out. So we'll just go 4 weeks out, right? Sell a put. And you want to sell, not too aggressive, okay? So 121, you could probably go to like 112, 110 to 112, somewhere in that range. Boom. Sell a put, right? Make a credit. Well, damn, the spread's kind of wide. You'd probably make like $200 on that. And then what you're going to want to do is buy 100 shares. So obviously make sure it's a good company that you can also afford. If you don't have $12,000 in your account, then you're not going to be able to do this with NVIDIA. I do know SoFi. SoFi is a really good stock. That's around a little under $8 a share right now. That's a good company that you could probably do this with for people that have less capital. But yeah, after you buy your 100 shares, then you're going to want to sell a call. Also decently out. So 4 weeks out, I'd probably go like around the 130. I think that's decently fair. That gives you $9 of stock appreciation. So times 100 shares, $900 plus you probably make close to, we'll just say close to 260. That's in the middle of the bid and ask. So you're making 260 on there. And what did we say on the other one? Like 190 or $2, I think we said $2. So you got $2 and 2.6, that's $460. And if NVIDIA stays the same, you profit on both ends. Your cash secure put just made you 200 and your covered call just made you 260. So you just collected $460 in a month with absolute no change of the stock. If the stock fell down, $8 or less, guess what? You still profit on both ends. The stock could fall $8, but your cash secure put was in between 110 and 112. You still profit that $460 because your cover call is now way out of the money. You still do that. If NVIDIA expires at 129, it goes up, not quite to your cover call. Guess what? You still profit both ways. So you have like a $20 margin, okay? You have a cover call at 130, and we'll just say the cash put's at 110. You have a $20 range. If NVIDIA just closes somewhere within that $20 range, you're going to profit on both sides. Now let's say, okay, obviously it will not close within that $20 range. And for some instances, okay, these are month out contracts. So, if we had a big bearish turn, it might go below 110. Well, if it goes below 110, your covered call is still going to print. You're going to collect that 260 regardless. And if it goes below 110, you can either take ownership of the shares If you want more shares and you're like, well, hey, I've been wanting to add more shares. This is a pretty good price. Boom. You could take more shares and then you could just roll double covered calls. But then that would be more like the wheel strategy. So it can turn into the wheel strategy if you want it to. But, you definitely want to strangle for a little bit until the stock reaches a point to where you're just like, okay, like I got to have these shares at this price. This is too good. Then you would want to run the wheel. That would be a better time to start running the wheel. But right now, NVIDIA's been, I'd say look, past 3 months, it barely changed at all. So this strategy would have printed 3 months worth of premiums very, very fairly. Yeah, you might have need to roll something at one point, but who cares? It's not a big deal. But let's just say it goes below 110. You're like, oh crap, I don't want to own ownership. Then you just roll it down. You just roll. For instance, I have this 108 put. If I did not want to take ownership, you just hit roll position, or if you do not have Robinhood, buy to close for 77 cents, and then sell to open a further date out. We'll go out another 2 weeks. And then since I had a 108 and I bought to close at 77, you just want to make sure you're getting more than 77, right? So I could go down to 102 and get, it says roughly 92. So I'd go out 2 weeks and I'd lower my strike price $6, and you still get a credit of $15. So this strategy, as long as you're willing to play the long game, just in case the stock goes below your put and you don't want to buy the shares, if you're willing to play the long game, you can't lose with this. As long as you pick a good stock, that is the most important thing. Don't pick a company with a 300 PE ratio who's going to have PE compression in the near future. For instance, Tesla, when it was over 1,200 a share, stock split 400 a share. That company was very, very overpriced, and if you would have done it on that company, obviously this would have went terrible. So good company, good evaluation, and preferably something with some decent premiums too. Now the more implied volatility, the more risky the stock can be. But if you have a good company like NVIDIA for me, and honestly Tesla around the low 200s is probably a little safer, especially than the 400s that it was. But yeah, and this way you print money either way you go. Either your worst case scenario, one of your ways is going to print money, and the other one you're going to have to roll out a little bit. Worst case scenario. And then you take ownership, boom, turns into the wheel strategy. Boom, if you want to let your cover call go at 130 and then sell 2 puts instead, boom, you could do that as well. But that's how I'm strangling NVIDIA. I did add a little bit of money into my account just so I could sell another put. So this was something I did today. Date sold 9/30. That is today. It expires in 3 weeks on October 18th. I sold it for $101. It is currently at $77, so I'm up $24 or almost 24%. And that is just going to be a little cash grab for me. Honestly, if NVIDIA did tank to 108, I may buy these shares at 108. As you can see, since I got $101 as a credit, my break-even price would be basically $107. So it would be like I'm buying it for 107 because of the credit I got. So I may take ownership, or may not. This 115 put, I will definitely not be taking ownership if it did get below there. This is kind of a cash grab for me. Still have $213 to make by the 18th. And then my in the money cover calls. Austin in the money, get it? But these in the money cover calls, I'm just going to keep rolling up and out little by little. Hope that NVIDIA has a little bit of a downturn. Hopefully Nvidia can drop to 110. That would be ideal for me. Nvidia drops to 110, then I can roll these a lot better. I'll have, these things will be a lot lower. Instead of $13, they will probably be closer to like 2, which means I can roll a lot easier. But yeah, like right now, my cover calls might not be printing, but guess what? My cash secure puts are printing, okay? And that's how you do it. I'm up $212 on here, and the one I just sold today, I'm already up 24. So, that's how you do it, guys. And yeah, I'm a little cutting it tight with the margin here, but I turn on margin just so I could sell 2 more puts. Because fun fact, if you guys did not know this, if you options collateral, see where it says options collateral, $22,300, you do not have to pay margin on options collateral, okay? You only have to pay margin if you own a stock or if you buy a contract. But since I sold a put with 100% margin, I do not have to pay margin on it. I know it's crazy. It's like I'm borrowing the money, right? I'm borrowing $10,800 to sell this put. But I'm not having to pay any fees or any margin on this because it is an option collateral. I do not own the stock. It's a weird little fun glitch to take advantage of, right? So basically, I'm collecting $101 of premium with someone else's money for free. I am borrowing this money for free, essentially. Now, if I were to take ownership of the shares, then it would be margin used, and then I would be paying, I don't know, what is it, around 6% interest on it. But that's how you strangle, guys. Totally great, powerful strategy. If you guys want to check, last month the S&P 500 is up almost 2.5%. My portfolio is up almost 5%. So we're beating the S&P 500 right now. This works. It is a great strategy. If Nvidia drops to like low 100s, I might just pick up those extra 200 shares from these puts and just sell 4 covered calls. That's a very good possibility. But I didn't know you could do that. That's pretty cool. But yeah, guys, that's what I'm doing. Great strategy, very powerful way to make money. That's all I got for you guys. Peace.